Welcome to the panel Tackling Climate Change, Public Markets versus Private Market Strategies. In this panel discussion, investors will share strategies to tackle climate change within both markets and the benefits and challenges of applying a multi-asset strategy, recognizing the interconnectedness of global markets. We are pleased to be joined by Narina Mnatsakanian, Executive Director, Impact and Sustainable Investment at Sumi Capital Management, Pablo de Muller, Founding Partner at Sumi Capital, and Vincent Trischijn, Global Head of ESG and Sustainable Investment at ABN AMRO. The panel will be moderated by Sean Gilbert, Director of Member Engagement and Capital Mobilization at the Global Impact Investing Network. Sean, I would now like to give the stage to you. Enjoy the discussion.
Thank you, Chantal. And welcome to everybody who's joining us today for this session on climate change and strategies for public and private markets. I'm delighted to be joined by a distinguished panel today that brings us together some professionals that cross the range of different asset classes and also have diverse experience in terms of the types of institutions they're working with and the types of sectors that they've invested into, both from the current roles, but then also these are three individuals that come to us with a long personal career in the financial services industry. We will be, as the title says, talking about climate change and some of the different options available as investors think across public and private markets. I'm going to maybe open with a bit more of a context in terms of setting the stage for our discussion. As I do that, I would like to invite the audience to look into the polling section on the right-hand side of your screen. I believe it'll be on the right-hand side of your screen, where we've put up a poll to try to ask for some basic information, just to have a better understanding of who's joining us today. Please go in as I provide this introduction and tell us, just answer one question for us about the type of organization that you're coming from. So maybe before turning to the speakers, and I'll offer a few opening comments, turn it to the speakers, and then there's also going to be a question and answer or a line open where at any point, please go ahead and start posting your questions or comments, and we'll begin to integrate that into our discussion. So as a bit of background around why are we talking about public and private markets, I think most of the people attending the symposium will probably be aware of climate change, and it's probably been an issue that has been somewhere in terms of your field of vision or in terms of the kind of work you've been doing for some years if you've been working in sustainable investing. The most recent report from the IPCC, the body of scientists, the global body of scientists supported by the United Nations, has just released their most recent update, which has reaffirmed all of the previous findings about the trajectory for climate change and the challenge that's ahead of us. And it's actually strengthened some of the analysis and some of the conclusions that have been drawn earlier. The report has also been followed by some recent scientific papers that have also been published that are pointing to some of the important Earth systems that help keep the planet the way we know it and have lived within it for decades. And these are natural systems that have unusual names like the Atlantic Meridional Overturning Circulation. It's just a paper that was published over the weekend. And these scientific surveys are giving us very uncertain signs about the stability of these systems. So the urgency is even greater than it has been. The official target that most people try to work with and governments have laid out for us has been the idea of trying to keep warming within 1.5 degrees Celsius. Now, that's important to note that that doesn't mean it's a good outcome. It just means it's less likely to be a very bad outcome. And the science tells us in order to be able to achieve that target of limiting warming to within 1.5 degrees Celsius, we have two important numbers that investors and businesses need to be thinking about together with policymakers. The first is we need to roughly have our carbon and our GHG emissions by 2030. That means carbon dioxide, but also some other important gases like methane. And then second is by 2050, we have to reach a point where we have net zero emissions. which means that not only will we have to have substantially reduced our climate emissions, we also will need to be in the point where we are taking out GHG gases from the atmosphere in pretty significant quantities. Now, investors have been pursuing climate action for quite a long time. And increasingly over the last year or two, we've seen a number of them that have been trying to take this idea of 1.5 degrees Paris-aligned investments, net zero, and try to use that as the foundation for developing a sustainable investing strategy. Now, there are three things that need to be kept in mind, or three challenges that this raises for an investor. The first is we need to be looking at the whole portfolio. So across all of the asset classes, all of the investments, how will these align with the goal of reducing emissions by about half by 2030 and by achieving net zero by 2050? The second is we need these targets and these strategies to be tied to real world changes. So much of the early approaches around sustainable investing focused on trying to find the best companies in particular classes, or finding companies that were comparatively better than others. At this point, what the science is telling us is that might not be sufficient, and that our strategies need to be tied to real world targets and real world concentrations. And third, as I said, it also means that mitigating or reducing emissions is not enough. We also need to think about investments that will lead to removal of greenhouse gases. So for an investor, as I said, this means you need to be thinking about a range of different kinds of investments. You need to be thinking across the asset classes. And that brings us to the focus of our panel discussion today, which is recognizing that there are different opportunities across public markets and private markets to be able to approach mitigation, to be able to approach innovation, and to be able to approach removal. And those require different types of strategies and emphasis on different sorts of investment sectors and industry verticals. So, as I said, we've been joined with a distinguished panel today that brings a range of experience across different asset classes. And I'm going to maybe start by opening and inviting each of the panel members, perhaps first just to say a word about yourself or your organization, if you'd like, but then to tell us a bit about how you've been approaching climate strategy. And I think there are two questions that I'd invite people to respond to in some form. The first is, how are you looking at these differences between the opportunities in public and private markets? How do you approach setting your targets across the different sorts of asset classes? And what are some of the specific differences in the opportunities that you see between different asset classes that you're trying to focus your strategy to help you pursue and explore? So with that, I'm going to turn to the panel, and I'll go in terms of the order in which I see them on our screen, which would be starting with Vincent from ABN AMRO, followed by Narina, and then we'll finish with Pablo. Vincent, let me turn the floor over to you for some opening comments.
Yeah, thanks a lot, Sean. So my name is Vincent Triescha, and I head the ESG team at ABN AMRO. Yeah, for those who don't know, ABN AMRO, we're a large retail and private bank in the Netherlands, but also we have private banking activities in Germany and in France with Beetman Bank and Nevlies OBC. My department is responsible on the one hand for the sustainability criteria and policies for all our investment activities and investment services. And on the other hand, we're also highly involved in product development for SFDR Article 8 investment products, but also Article 9, including our impact investing offering, where we offer a mandate and, of course, also individual impact funds. Yeah, and I must say, carbon emissions and climate risk, more particular, is top of mind for the bank. Sean already mentioned the IPCC report, but I think also more broadly, we see a lot of regulation globally on CO2 emissions, most predominantly in the European Union with the Green Deal, Fit for 55, but also now an increasing CO2 price with the ETS system. And I think that combined also with the news of the International Energy Agency that has published its Paris-aligned scenario, clearly alerts the industry that this will most likely impact our investments. So we take a look at it from a risk perspective, but of course also from a more altruistic perspective, given the motivation of our clients that would really like to contribute with their impact investments. And that translates in several ways into our policies. Of course, from a quantitative point of view with our CO2 targets, but also risk measurements and the scenario analysis that we do for entire portfolios, but also for more individual or particular investment processes, where we also try to focus on the more qualitative part. So we think, especially when you invest in companies, it's quite important that you also have a view on the management of companies. Are they able and willing to drive the change that is required for the business to actually meet these targets? Or when they don't have the targets, can you actually motivate them to, for instance, report according to the CDP initiative? So in many ways, we try to move the companies into the right direction. And Sean, as you already pointed out, the private investment side is a different ballgame compared to the public investment side, where more data is available. I think with many of our private investments, you do have to take you have to take the qualitative road and really sit down with the management to really understand the strategy and the business model and how they can change, or what is even better, what we usually see on the impact investment side, how they can contribute to the solution and how that is part of their business model. So definitely a different approach for public markets compared to private markets. On the other hand, I think the fundamentals are pretty much the same, and we think that for both, this qualitative view is necessary.
Great. So no, thanks, Vincent, for your opening comments. So just to follow up on some of that. So my name is Narina. I'm Mnatsakanian, and I work at Kempen. I was heading till recently Kempen's sustainability and impact team, and since a few months we've been integrated into our largest sustainability center under the group level for Landshut Kempen. And so we with the team are also overseeing the whole sustainability strategy for the firm, and setting up policies, including for climate change. And Kempen overall, we are a Dutch-based fiduciary manager. So we have two parts of the business: fiduciary side, where we work with pension fund clients in the Netherlands and the UK, as well as the active fund side. So we have most of our funds are based here in Netherlands and all active. That's why it makes it easier to engage and implement strategies. Last year, we have committed to net zero for all of our investments, and we have set targets for Paris alignment for all of our listed investments by 2025, and for our non-listed investments by 2030. So what it means is we would like the listed portfolios to be on the pathway earlier, because as also Vincent already mentioned, there is a lot more data available, there is a lot more maturity in reporting, and for private investments, I think we need to really start with getting all the data and making sure that companies are starting to report, and then we can establish clearer targets. So what we're doing as well as a firm is we're translating these objectives from more longer term to even shorter term targets. So for what does it mean for different parts of the business, say in 2020. We have also set specific criteria for various types of funds, for more of our list, for example, for listed funds, for more sustainable versions, they have a sort of a higher reduction targets than for sort of our normal fund. So basically every fund gets a kind of budget. And I think that overall with the current upcoming SFDR regulation, the whole climate data availability should improve. both for listed and non-listed companies, but currently we do see much bigger challenges for non-listed asset classes. I mean, we also, a lot of people are not talking about the net zero, so that's also what we have committed to, sort of to be, for all investments to be Paris aligned overall by 2050 and to have actually net zero goal. But that's only possible, of course, if you're not only mitigating it, but also the use of nature-based solutions. So we are still in the early days with that, but we are looking at, you know, what could be the role of nature-based solution in this whole discussion. And we have also recently launched a new regenerative kind of agriculture SDG land fund that is also looking to invest in some of the kind of nature-based solutions around regenerative agriculture. So that's a more specific area as well. I'm happy to talk about more.
Thank you, Son, for the opening remarks, and Vincent and Narina, pleasure to share this panel with you. From Sumi Capital, we are an independent private equity firm with two investment programs, one dedicated to SMEs and the other to sustainable infrastructure. So we are on the private side of the investments. Basically, our goal towards climate change is a bit different from both strategies. In the SMEs strategies, what we do is apply the typical ESG framework where we analyze the materiality effects of the company, then set up the risk analysis, which then develop the policies, the right policies that set up the KPIs and the goals. So as you were mentioned in your previous discussion, here the data is key. So first we need to obtain the data. The good part about the private investments is that you can really engage your portfolio companies, because we are sitting on the boards. We normally take majority or reinforce minority on the companies. So we can set up policies and the goals to be obtained and be aligned with our main objectives in climate change. And the other thing that is very important is to try to show that this is also a value creation for the companies. We really believe that more sustainable companies give also more sustainable returns. So through showing that this is a tool to value creation, and we have several examples in our portfolio companies, by exclusively analyzing, for instance, the carbon footprint of the companies, we can see opportunities in energy efficiencies, so reducing cost. We can increase sales by, selling better to our stakeholders, or our willingness to be aligned with a more sustainable world, and also getting at some stages better financing. So this is the key of our role to play within SMEs, to set up rules and to be reinforcing these goals. Regarding the infrastructure division, is a bit different. Since the infrastructure division, it's an impact fund with a clear goal to tackle the climate change. Basically, it invests in all the assets related to energy transition and circular economy. So it goes a bit farther than the ESG. It goes to try to quantify the externality, the good externalities that our assets produce to the society. We do that through key impact indicators, not exclusively the CO2 emissions, but also fossil fuels avoided, water that has not been enterprised, jobs creation, etc., biodiversity. So, in fact, we have set up an internal tool that helps us to show that to our LPs by applying what it's called a SEROI tool, which is a social and environmental return of investment, where we try to quantify it in economic terms what those externalities provoke to the rest of the stakeholders. So different ways of setting the climate change goals. We see the public markets as let's say the best practice to follow. So for us, it's very important how the public market is evolving, and we show to our investees what the winners are doing and why they are doing that. So it's helping also in implementing those strategies to the private sector.
Thank you. And so there's a couple common themes in what all of you have been sharing. One of them around a fairly specific and explicit approach to setting targets. You also have all talked about issues that come up in terms of the availability of data, whether that's quantitative or qualitative, and how it's more available in public markets, perhaps less available in private markets. You've all been talking as well about probably what's been a traditional approach of trying to engage with companies and changing them. But you've talked about that more in the specific context of targets, and also touched briefly on some of the differences between an approach to trying to get companies to reduce solutions and investments that try to bring new climate solutions into the market that either allows companies to try to improve their own, other companies to improve their portfolio or their profile, or in the case of nature-based solutions, is just simply helping to absorb emissions out of the atmosphere that already exist. Maybe we could start by talking about how you're using targets and how that's sort of affecting or influencing your choices about investment decisions. So as you start to look at your portfolios, for Vincent and Narina, it can be public or private. Pablo, obviously, you're working in a private portfolio. As you're trying to set these sort of targets and think about what would be an appropriate budget to work with, how does it start to change the investment choices that you're making, whether it's in terms of the types of companies that you'd like to be invested into, or how your engagement with company influences your choices about remaining invested in companies? Vincent, I see your microphone is on, so I invite you to start, and then others can react as you like. And I'd also invite the audience, if you have comments or questions at any point, please feel free to post them and we'll try to draw them into the conversations. Vincent.
Yeah, maybe it's good to start off with the public markets there, because as was mentioned before, most data is available there, and that's the public markets are also a front runner to a certain extent. And what we see a lot in the industry with asset managers, but also questions from asset owners, is always focused on CO2 emissions and also the current state of the CO2 emissions, or the reporting backward looking. And I think that in a way that's of course interesting, because those are the facts. Although we see a lot of data differences there as well. But we are much more interested into the path of the company towards Paris alignment, and that's much more forward-looking. I think what we try to do is to encourage, when we speak to the management of companies, is to get an understanding of the pathway to the Paris alignment of that individual company, and also to make an agreement on the milestones, so that we can also measure and monitor if the company is moving into the right direction. And that's a little bit different than what we see in the industry, where there's much more focus just plain on CO2 emissions reported over the last year, for instance, while some of the companies with higher emissions and have very ambitious plans for the next few years, clearly that's not reflected in that number. So again, I'd like to emphasize the more qualitative view, and that you have to look towards the future to make a good investment decision.
Yeah, maybe indeed also to add to that. So we believe in engagement versus kind of exclusion discussion for the active part of our investment. So for the passive, that's different. But overall, I mean, if you just sell a company, you're not really solving the issues. So I think what we are really trying to do is, if we want to make sure that our portfolio are on that 1.5-degree pathway towards Paris, all of the underlying companies we're invested in eventually need to be on that pathway, but they may not be initially there. So what was important for us is we have an engagement framework that we developed and are using internally, and we review all companies, and especially now starting with the most energy intensive sectors, and we analyze what are the largest emitters, do they actually have targets, in what sort of time frame, are they credible, are they implementing it, what are some of the issues, and so we then engage with those companies, and if we are comfortable that over time these companies are on the right way, although maybe currently they're not, then we can stay invested as long as we see that progression. But of course, at one point, if you have companies that are not willing, they're largest emitters, and they do not have targets, that will have consequences for whether or not we will be able to stay invested if we want to meet our targets. So I think that will, this climate commitment will have implications for our portfolios.
And maybe if we could, Pablo, if you don't mind, if we could pick up on just that for a moment, and that I think the question also applies in the case of private markets, but how do you decide what's enough? I mean, we talked beforehand about how we have targets which are kind of that try to draw us, that identify a specific budget. We know that we have certain real outcomes that need to be achieved by 2030, and then by 2050. Progress, how do you decide whether or not the actual progress is enough, that it's worth trying to either make an investment into a company or stay invested?
Well, in our case, we do it case by case. As Narina was saying, we rather prefer to take the engagement strategy rather than the exclusion strategy. It's embedded within the whole investment strategy. So since the scouting or looking for opportunities to invest towards the due diligence, where we set up the goals that we were to achieve, then the execution of the transactions, where we engage the management companies and the rest of the stakeholders within these strategies. So we set up the rules, let's say company by company and investment by investment. And also our engagement goes beyond we have a 10-year period fund, so it has to be also after our decisions also in the divestment part. Within the divestment policy, we have a responsible investment policy where it states also that on the selling of those assets, the new shareholders have to take, into account these goals. This is like a kind of purpose-driven company where we try also that our investees have some purpose to follow. So for us, it's difficult to set up goals previously. We set up the goals to be achieved, let's say asset by asset. It's a bit different from the impact side, where we can establish goals regarding the renewable assets that we want to invest, or the circular economy, etc., where we have set up goals previously, and then we present that to the investors.
Yeah. So can you, on this, in terms of the point around introducing some of these targets and some of the climate engagement that you've been doing in the private markets, perhaps could you share something in terms of how it's influencing some of the specific investment decisions? What are some of the changes that you could foresee in a portfolio over the next 2 years as compared to the portfolios that might have existed before introducing some of the more science-based targets? How is it changing some of the thinking about where the opportunities specifically are?
Well, we have, in our case, we have reduced by 20% our emissions in the portfolio companies in the last 2 years. So the first thing is, as we mentioned, the first thing is to be committed to quantify that. You cannot set up goals if you don't have still the data. So first thing is to have the data, then to set up the rules, and then to follow that, and to engage in ever efficiency process. So every time that we achieve a goal, we put a new goal. We are the first, the continuous improvement, rather than setting a goal to 2030. That for us is a bit too long. We set that the goals from 2 years to 2 years, and then we set up new goals.
And I see that some questions are starting to come through. One of them is related to solutions, and we'll come to that in a moment. But one of the other questions is specific to what we're discussing right now. And it's asking if you could talk a little bit more about the difference between engagement in private markets versus public markets. What are differences in what you're able to accomplish, either in terms of some of the influence you have or some of the outcomes that you're able to achieve. Narina, your microphone is on.
Yeah, no, thanks, Sean. So in private markets, so we have some also dedicated impact strategies where we also target, for example, as well as a goal, energy, sort of renewable energy and that type of investment. So there, it's obvious that you're investing in solutions and you're looking at what type of projects that you do. But if you look at more broadly, I think it really depends on the type of industry that you're investing in, the type of fund. So in some cases, this will be quite relevant, right? If you're investing in more energy intensive companies, and in some cases, if you do say early stage VC or really small companies, then maybe some of this will be less relevant. So I think from our experience, we've been trying to get now the CO2 data from the private investments, and the data quality and availability really depends on the sector and the type of strategies, and also location, whether it's in developed or emerging markets, whether it's subject to some regulation. So I think these are all factors, they play a role.
Please.
Yeah, well, on the one hand, I think transparency is key, and data. It was mentioned already. But on the other hand, what I do think is important is the change that we can accomplish. So just by reporting, you're not there yet, and I think that is also what we try to keep in mind. So also with the high risk sectors, or I think a key in the dialogue and in engagement should be the change, and even in some cases we deal with smaller companies that are not willing to report, or they cannot report, or they have a good reason not to do yet, and then it's up to us to determine if they what are they doing, are they willing to change, and sometimes it's also common sense. Obviously we should not be naive, but in some cases we know that the company is doing the right things, and we should also give them some time to report. Clearly that's not the case for larger companies, where we see SBTI had a science-based targets that they should publish, but in some cases, especially with projects in frontier countries, you have to take a different approach.
Yeah, just to be a bit provocative, I'm going to say that one of the challenges with engagement is it does take time, and all of the science tells us we're out of time. And so I think one of the questions that's come through is maybe speaks to this, which is asking, how much change can you achieve with the comparatively small pool of investments that exist in private markets as opposed to public? And maybe with the permission of the person who's asked this, I would change it around a little bit, or maybe reframe it slightly, of saying, given the very specific targets that we need to hit, which are extremely aggressive emissions reductions, what's the difference between the contribution that we need to get out of public investments, or listed companies, as opposed to the contributions that we would need to get out of private investments to be able to achieve our goals? Pablo, please.
Yeah, so let me take that because it's very important. There is, in our case, and we see it very often, there is a lack of financing for small and medium-sized projects, which are key, and they cannot be addressed exclusively by the public listed companies. So we find a really investment gap, since a lot of, for instance, in the impact fund that we're doing for the infrastructures, deals from 10 to 50 million euros are not addressed by anyone, and this can only be addressed by the private sector. So, and most of the small opportunities that we do, that is true that it's small compared to the rest, but the thing is that private market is growing very fast, and it is growing because it has a role to play, and it has a role to play to fill this gap of size in opportunities. So there is where we think also there is better risk return opportunities, but also the need to invest in those opportunities. So to fill in this gap, I would say.
And I think that Narina, go ahead, and then I'll bring in the next question.
Yeah, no, I just wanted to add, I mean, I think, of course, you look at the largest, emitting sectors. I mean, if you look at, I don't know, oil and gas, utilities, I don't know, cement, construction. I mean, a lot of these companies are listed, probably not all, but, you do need to basically shift industries. And I think there is always a lot to win if you make progress in public markets, or, I mean, whether you call it private public, in certain sectors that are most energy intensive. So I think, yeah, you can sort of focus on the largest emitters to start with, whether private or public in your portfolio.
I think certainly the answer, at least the way we understand it through our members, which with the 350 or so of them come across, span sort of the range of institutions of different size, different types of asset owners working in public and private markets. I'd say we very much hear a distinction between looking to private markets, particularly as opportunities to try to scale disruptive solutions, and looking to public markets as the place where we have to have the massive, where you have the mature industries and the mature economic activity, which needs to have a massive reduction in terms of its GHG footprints. It's not all CO2. Methane is also particularly important, and that sometimes will sit between, because industries that produce large amounts of methane, which the IPCC also identified as being one of the critical path dependencies for being able to achieve targets, isn't always driven directly by the largest of companies. But maybe moving to the question which came in earlier, which I think connects to this question of public and private, was speaking in terms of solutions. And so, as we said at the outset, much of what we've been talking about so far has been, how do you reduce emissions from existing companies? Now, that obviously sometimes can be done by improved processes, but sometimes those reductions also are dependent on having new technologies, new solutions, new ways of doing business. And Narina, you specifically mentioned nature-based solutions, which have a unique role in terms of their ability to remove carbon from the atmosphere. So maybe if we could take a few moments to talk about how you think about investing into solutions as opposed to investing into sort of reducing or changing existing industries. But maybe start with talking a bit about what's taken you to nature-based solutions within, as part of your climate strategy, Narina.
Yes, I mean, I think, as I said, this is still very much in the infancy. So if you look at it, they need to play a big role. So if you look at different scenarios, how to get to 1.5 degrees, I think there are estimates that the nature-based solutions could remove, 7 to 14 billion ton equivalents per year. So that's, quite significant, and that could include, reforestation, protection of current forest, peatlands, but also soil carbon sequestration, reforestation, agroforestry, etc. So there are quite a few of them, and as I said, I mean, I think we are just in the very early days of that. But what is also important is, if everybody wants to get to net zero, like, is there actually enough sort of demand versus supply? If you look also at the large companies in our portfolio, oil and gas or other sectors, everybody talks about net zero and wants to develop this market. So it's also, I think the question is is it credible? Can it actually take, if you look at all of the commitments together, is there going to be enough of kind of nature-based solutions opportunities to meet those net zero? So that's something we've been also looking within IGCC and with Ceres and other investors, and have published some expectations and papers. So I think it's still in the early days. I mean, the questions here also in the chat is more specifically for our the fund that we have. It's a land, so it's a regenerative agriculture fund. It's not specifically nature-based solutions fund, so it invests in agri-land. But one of the things we're also specifically looking at and we want to measure is around soil carbon sequestration. How do you get to higher kind of carbon management in the soil, but also looking at biodiversity and more broader holistic management of this land. So this is maybe a very specific project, but I think the whole topic is a lot bigger and needs more, I think, attention and focus in the coming years.
And I think nature-based solutions are one aspect of solutions. Probably some of what work you're doing, Pablo, with circular economy and perhaps to some degree the energy infrastructure is also related to solutions. Can you talk to how you think about the technology side?
Yes, the good thing, I mean, the good news, the only good news about climate change is that technology is catching up. We have seen the developments, for instance, in renewable energies that now are even more profitable than fossil fuels. We are now investing in things like renewable gases, storage, smart grids, and within the circular economy, a lot of new technologies coming from waste treatment plants. So yes, the technology is catching up. Probably needs to be catching up quicker than what it should. But investments are needed in the private sector. Private sector is the one that invests more in these new technologies. So what we do in our infra fund is just put in place those new technologies for the projects where we invest. So that's from the solution side that would be one of our investment funds would focus on in that in the solutions side.
Thank you. We're coming close to the end of our session, and we'll take at the very end of this, the last thing we'll do is give each of our panelists a moment to leave a final thought with us. But I see there's a question in the chat around charging substantially higher compensation. Sorry, my screen has moved such that I can't quite see the question. Charging substantially higher compensation for the services. I'm not sure I fully understand the question. I think it's something, and I see another one that's together with it around solving the problem of climate change without solving the bigger social issue and the gap between the have and the have not. I think maybe it's a question speaking to the urgency around being able to develop some of these approaches, and there will be some trade-offs in terms of winners and losers in investing into new technologies and transitioning economic activity from one base to another. I think what people often talk about is a just transition. Maybe as a last question, just to invite any of you to speak on it, we've talked about the urgency around the science of being able to try to achieve certain climate goals. What are some of the questions that come up with around some of the social consequences of that? Or how do you think about some of the social issues that come up in terms of looking at different solutions or different opportunities around climate investing? We'll make that the last question for our session before we then just have a brief wrap up. Vincent, please.
Yeah, I think this is a really good point. We spoke about some of the solutions to this challenge, and you see that some of these solutions, small scale, make sense, but when you scale them up, you run into different issues, human rights issues, many social issues. So we're well aware of it, and I think what is important that on the CO2 side, you can offset and you can say, it is about the net result. You have some emissions on the one hand, and you have a lot of reduction on the other hand. This is a good investment, but I think socially, that game doesn't work. You cannot say, like on the human rights side, on the one hand, I build a school, and on the other hand, I exploit all the people in the community. So I think we always try to make sure that also with these solutions to environmental challenges, you have to do your due diligence on the human rights side, on the social side, and make sure that that everything that you can mark all the checkboxes. But it makes clear that with the skill that is required to tackle this problem, many more problems arise, and I think we all have to be well aware of it.
Thank you. We have just about less than 1 minute left, if I can see my countdown timer correctly. So going in reverse order from Pablo to Narina to Vincent, just give each of you an opportunity. If there's a closing thought which you would like to leave with the audience, please feel free to go ahead and do so. Starting with Pablo, please.
Well, thank you very much. I think that as we have stated, I think that the private market has also a role to play in the climate strategy, and we look at the public market as the best practice to follow. So I think that small projects and the finding gap in the small projects is key to tackle these also social issues that we were discussing. We have seen that in the energy transition and the current energy prices that we are living.
Thank you, Narina.
Yeah, no, I think the closing thought, I mean, this is clearly going to be one of the biggest challenges now that we're of our time and that we're all working on. And I think it's important to, of course, look at what are we doing with our investments, but also what we're doing as individuals, and what, and really focus on taking action and making real changes rather than it being just, another target or sort of a paper improvement in your portfolio. So really focusing on action today. Thank you.
And Vincent, the closing thought before we turn it back to Chantal.
Yeah, I think many of the questions are around should we address this in public markets or private markets, and I think it is very important that we address the problem across all asset classes, across the entire spectrum. We did discuss change of processes and business models, but in reality, what we see is a lot of divestment as well, where listed companies sell activities to privately owned companies. So I can't stress more that we have to address this both in public and in private markets.
Thank you very much. I'd like to extend a thanks to all of our speakers for today and to all of the participants for joining us.